Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for November 15th, 2022. I'm Ken Animo, Chief of Analytics over here at DAT, and I'm joined by Dean Croak, who's our Principal Industry Analyst on location in Dallas, Texas for the Women in Trucking event. Morning, Dean.
Yeah, good morning, Ken. How's things today?
Pretty good. It's your second trip to Texas in under a week, right?
Yeah, two conferences specializing in different parts of the industry. We had the Freight Fest 2 weeks ago, and this week we've got Women in Trucking. About 1,500 people here. It's a huge event. We've got people from all over the world exhibiting. DAT's got a booth, a lot of new trucks here. The Waymo autonomous truck is here, the fully driverless truck. I'm kind of shocked at how many cameras this thing's got, but lots of very cool products to check out. 2 days of conference left, so it'll be a lot of fun.
That is awesome. So for those not familiar with this particular program, we're here every Tuesday at 10 a.m. Eastern, talking about trends in the freight market, looking at some data, but most importantly, answering your questions. So if you have any thoughts, comments, questions, drop those into the chat, and our marketing team will get those over to us behind the scenes. We've got a lot to cover today, so I am going to jump into our key points of the week. National average spot rates dip a little under a nickel a mile, so that's below the 2017 levels for the first time this year. I looked at it yesterday morning, and we still have got a lot of headroom over where we were in 19, which is sort of the low watermark in modern history, the last 5 to 7 years for rates. I'm sure Dean will cover that in more detail. Reefer spot rates are struggling to reproduce that Thanksgiving bump we typically see. A little bit of a teaser for our question of the weeks, perhaps. Carrier equipment posts reaching new record highs. We're still seeing record transaction volumes on our load board. It's just that paradigm has shifted from posts to searches, which you would typically see in a slower environment. Thankfully, Hurricane Nicole not having a huge impact down there on the freight markets. I know there's been some property damage reported, but thankfully that wasn't as bad as people were perhaps expecting. And then the West Coast imports decreased as West Coast, the negotiations drag on. And I will add one little piece here that's not. We had the Boilermakers, I believe, not Purdue, but the labor union refused to ratify the contract negotiation with the rails. I'm hearing more and more from a lot of my sources in the industry that this is causing blood pressure to rise among rail and trucking executives. So perhaps Dean and I can chat more about that at the end of the show. But for now, I'm going to turn it over to Dean to walk through our market update. Dean?
Thanks, Ken. I noticed that the JOC reported this morning that the Oakland port, there was a work stoppage there. I think it was yesterday, Ari was reporting. So lots of tension on the West Coast. Let's start off with our market update, having a look at our dry van load post volumes and carrier posts. Again, seasonal trends kind of emerged again this week, no surprise. Volumes dropped about 13% last week. We normally see volumes pick up right after Thanksgiving in the dry van sector. Load post volumes are still about 45% lower than this time last year, but the number of carriers posting their equipment in search of loads is probably the more concerning statistic. Volumes hit a new record high last week. 6% more carriers posted their equipment last week than in the middle of April 2020. Of course, that's when the world went into lockdown and demand crashed. The load-to-truck ratio decreased to 2.13 last week. About the opposite of that, refrigerated load posts went up last week, again, seasonally tracking along with what we'd expect. Load posts are up 2% as shippers moved a lot of inventory into retail markets, still 53% lower than this time last year. Carrier equipment posts are just 2% lower than the record high set in mid-April 2020. So both dry van and reefer load equipment post volumes are sitting around April 2020 levels. The load-to-truck ratio last week in refrigerated dropped to 4.44, down 10%. Flatbed dropped 16% last week. Load post volumes are now 66% lower than mid-November levels last year. Volumes, of course, typically decline this time of the year along seasonal trend lines, so no surprise there. They are tracking directionally with 2020 and 21 levels, albeit at about half of the load post volumes of those years. Carrier equipment posts and flatbeds belie the overcapacity in that market. They're at record high levels following last week's 10% increase in equipment posts, and even 13% higher than the prior record peak in flatbed capacity set in October of 2019. The load-to-truck ratio decreased to 2.13. So having a quick look at our markets this week, in the dry band, the same storm system that produced record-setting rain and heavy mountain snow in California set up the season's first significant winter storm in the Pacific Northwest and Northern Plains. Capacity tightened as a result. Rates were up 7 cents a mile in the region to $1.49. Most of the regional rate gains occurred in Pendleton, Oregon, where rates increased 11 cents a mile to an outbound average of $1.57. Remember, these are line haul rates excluding fuel. In the largest spot market in the Northwest, rates in Seattle increased 2 cents a mile to $1.29 for outbound loads. That makes it 4 straight weeks of gains. And in the Midwest, capacity tightened slightly in 3 of the 4 markets in Indiana, reversing a 3-week slide. Rates were up by a penny per mile to $2.03. Lanes like Indianapolis to Atlanta down to $2.22 last week after increasing for the prior 4 months. So capacity loosening on some lanes. Indianapolis to Atlanta is $1.17 a mile lower than this time last year. Just north in Chicago and Joliet, spot rates dropped 3 cents a mile to $2.19 last week. That's the first decrease in 4 months in those 2 markets, about $1.22 lower than the previous year. And in the New York Finger Lakes region, rates increased by 8 cents a mile to $2.04 in the Elmira and Syracuse markets. Lots to talk about in the refrigerated sector. Let's have a look at what's happening around the market. Nicole hit Florida last week, as Ken touched on at the start of the show. Load post volumes for outbound northbound loads were up slightly. Plenty of capacity, though. Spot rates decreased slightly in Miami. Line haul rates in Lakeland were up a penny per mile to $1.15. They'd been dropping for the prior 3 weeks. In Jacksonville, which is a much bigger spot market, rates were up 9 cents a mile to $2.27. In the Pacific Northwest and Northern Plains, again, reefer rates were up 13 cents a mile to an average of $2.03. Following last week's winter storm. It's also a pretty busy produce season for apples, pears, and dry onions. Load posts in that region are up 55% week over week, with most of the volume gains in the Pendleton market. Load posts in that particular market were up 35% week over week. Outbound reefer rates in Pendleton were up 15 cents a mile to $2.09, and they continue to climb along seasonal trend lines. It's on the 720-mile run to Stockton, line haul rates in this lane at $2.43 last week, 36 cents a mile higher than the October average, so they're on their way up. And according to DAT's ratecast, on that lane from Pendleton to Stockton, rates are forecast to peak in January at around $2.65. To give you an idea how much the market has softened, they peaked at $2.65 in January next year is the forecast. That'll be about $1.40 a mile lower than this year's January high of $4.05 per mile. So even though there's seasonal trends, rates are cycling along at much lower amplitude this season. Having a look at California market, rates reversed a 2-month slide in the California reefer market. Rates were up a penny per mile to $2.20. In Fresno, the largest reefer spot market on the West Coast, rates increased by the same margin to $1.80, while nearby Los Angeles carriers found rates slightly higher at $2.02. Having a look at flatbed, the prior week's tight capacity in New England has been a bit of a feature of the flatbed market. It extended into New York State last week. Flatbed markets following a regional increase. Rates are up 22 cents a mile to $2.40 in New England and New York. Flatbed load posts are up 32%. In Albany, lots of activity in Albany and Syracuse markets. There was a surge in spot rates in Albany. Line haul rates increased by $1.43 to almost $5 a mile last week. Flatbed rates in this market have nearly doubled in the last month, driven by solid gains between Albany and Philadelphia. Short haul 230-mile lane at $926 a load, excluding fuel. Last week's rates are $170 a load, higher than last month's average, and about $50 a load higher than the previous year. Having a look at the southwest border markets, Laredo and McAllen. Last week, rates were up 5 cents a mile to $2.23. That makes 4 straight weeks of gains along those 2 large border markets. A couple of lanes that are worth looking at there. The volume of loads moving between Laredo and Dallas up 6% last week. That's loads moved. Capacity was flat at $2.06, but that reverses a 3-month slide. Rates are now 36 cents a mile lower between Laredo and Dallas. And in Houston, it's our largest spot market for flatbed carriers. Load post dropped 6% last week. There was an impact on flatbed rates. They dropped 8 cents a mile to $2.32. One of the busier lanes for flatbed carriers, Houston to Fort Worth. Loads moved down 11% last week. Rates dropped to their lowest in 12 months at $2.80. One of the other lanes worth looking at, El Paso from Houston. So it's Houston to El Paso. Recorded the highest volume of loads in Texas last week, but capacity eased. Rates dropped to a 12-month low of 272. They've dropped about $1 per mile since June, so certainly some loosening capacity on some lanes to watch for there. Wrapping up our market update with our year-over-year look at spot rates, the downward direction of dry van spot rates is in stark contrast to the two prior pandemic years, as you can see on the chart. The market's gravitating back towards more seasonal trends. Of course, the record number of new fleet operators, including owner-operators, that entered the industry in the last 2 years. We're seeing an oversupplied market right now. Rates dropped by 2 cents a mile last week to a national average of $1.72. Now just 5 cents a mile lower than in 2017. Last week's national average is 80 cents a mile lower than this time last year. And in refrigerated, something really unusual is happening this week. Even though reefer line haul rates were up 2 cents a mile last week to $2.08, that's excluding fuel, this year's pre-Thanksgiving increase is both later than previous years and much lower than what we typically observe in the first weeks of November. I went back and looked at the prior 6 years for the first 3 weeks of November. So compared to the typical November gain from November 1 to Thanksgiving, reefer rates typically increase about 12 cents a mile. This year so far, they've dropped 2 cents a mile over the first 2 weeks of the month, but still time for them to pick up some of that. But I don't think we'll see anywhere near that 12 cents a mile. So national average reefer rates last week at 208 are 93 cents a mile lower than this time last year. And in flatbed, to wrap up our market update, flatbed line haul rates were relatively flat last week. But since June, they've dropped about 60 cents a mile. That's the more concerning statistic. The national average spot rate, excluding fuel, ended last week at $2.05. That's about 21% or 54 cents a mile lower than this time last year, and now about half a penny per mile lower than where we were in 2017. And with that, it's up over to Ken for the market update and the short term.
Thank you, Dean. So just to level set everyone on this chart, which we do every week, the blue line is the historical rates that we've observed here at DAT. It is a 7-day weighted moving average. It excludes fuel and it's long haul only. This one happens to be dry van. And then the colorful lines to the right represent our forecasting ensemble. So the green line is our flagship Raycast model. That's the one you see in all of our products, whether that be RateView, the RFP tool, et cetera, et cetera. The red line is a short-term weighted forecast. It much more heavily weights near-term data. And then the gray and the yellow are blends of the two. So what you're seeing here is, again, we've been talking about that model disagreement. We've been inching along every week closer and closer to when the point in time where the models really start to disagree. And, I think Raycast is kind of pulling from that 5-year history that it uses and believing that there's going to be seasonality that's going to drive rates up as we head into Black Friday. The short-term model, not so much. I've been wrong more times than I can count, but my advice here would be not to pay as much attention to the short-term model. It would be exceedingly rare for the bottom to fall out this time of year. It can happen, just like Maryland could beat Ohio State next week. We hope that doesn't happen, but it's not very likely. Let's move to reefer. Again, you're inching closer and closer to that model disagreement point with Raycast asserting seasonal patterns, the short-term forecast showing it falling off a cliff. I'm even less likely to believe this one, given all of the things that need to move refrigerated over these next couple of weeks, especially as we run up to Christmas. But again, always a possibility, which is why we show this line, even though we might not necessarily agree with it as analysts. And then flatbed is, again, a little bit of a disagreement, but pretty much all along the same trend. This isn't as big of a seasonal bump for flatbed. I think what you see here with rates is less volume driven, more just capacity coming out of the market over the holidays. It gets cold. It gets more expensive to move freight because people have to do load, check their load more often. Tarping, strapping, things like that just tends to get more expensive. So I would, again, probably find the truth somewhere in the middle of these forecasts. So with that, wrapping up the forecast and all of the charts and graphs, let's move to our question of the week, Dean. Actually, let me read it, Dean, because you're going to be the one answering it. Our question of the week is, other than turkeys, what are the main reefer lanes and commodities moving over the next few weeks?
Yeah, it's an interesting question. There's lots of activity. I think a lot of the reefer volume that we've been anticipating has moved, and sort of you'll see some last minute freight moving next week. But we're certainly at the peak of a lot of that volume. We saw some of our biggest gains on some of the lanes that move a lot of turkeys the prior week to last week. Christina Ellington, our market research analyst, did some research yesterday of some of the big lanes like butter out of Wisconsin. The big headline there is that retail demand for butter is softening in the West, pardon the pun. Apples, milk, potatoes, sweet potatoes, fresh turkeys, frozen turkeys, lots of things are moving or have moved. Some of the data points that Christina was able to pull together, some of the outbound lanes are really quite interesting. When you look at, I had a look at our heat map this morning for all of our reefer volumes at a state level. Even regional level. Pacific Northwest, last week rates are up 20 cents a week over week to $2.23. Of course, you're seeing a lot of apples, pears, potatoes, onions coming out of the Pacific Northwest at the moment. California rates are even up a cent per mile to $2.20. A lot of produce comes out of there, particularly leafy greens out of the Fresno market. Minnesota rates starting to flatten out there after being up about 12 cents in the last couple of weeks. The state of Louisiana was the really big one. A lot of sweet potatoes come from down there. A lot of refrigerated freight in general. Rates are up 55 cents per mile out of Louisiana last week. Texas rates up 5 cents. The other data point that I thought was really interesting, Ken, is sort of when you broaden it out and just have a look at what we call the meat patch. And I'll take Nebraska as the center of the meat patch. Inbound rates are up 23 cents a mile week over week to 241. So inbound up 23 last week, outbound up 14 week over week. So you're talking about pretty significant rate increases out of the meat patch there. So I think some of those lanes at a lane level, Twin Falls to Stockton at 283 is another lane that's climbing. Spokane to Denver. Pendleton to Ontario, again at 232. We covered that a little bit earlier. A lot of apples moving out of the Buffalo market, New York to Elizabeth, New Jersey. Rates are averaging 427 right there. Not a lot of joy for carriers running deep into Florida. Reefer volumes aren't that attractive right now, and there's plenty of capacity. So they're kind of the main lanes that you'll see running at the moment out of the Midwest in particular. But right now, when you look at a national level, there is plenty of capacity in the market. But on some lanes for carriers, there is some opportunity depending on the seasonal timing of the crops and the harvest.
Yeah, I don't know about you, but I bought my turkey. My father-in-law makes the turkey, and I typically kind of go to a culinary extravaganza, and I fully debone a turkey and smoke it on the Traeger. But I noticed like last year was 29 cents a pound. This year's 55 cents a pound. It's still remarkable for me. I mean, I bought a 20-pound turkey for, I don't know, $10. I mean, it's kind of crazy when you think about like the logistics that go into that. But yeah, I mean, I don't know that inflation is going to stop people from buying like littering the table with all of their holiday goodies. So I would expect it to be a rather robust shipping season. It's just the question becomes, how expensive is it going to be to ship, right? Because you're not going to be competing with as much general freight most likely this fall, right?
Right. Yeah, it's
so that's how I think about it.
Yeah, that you can see a lot of some of the markets where you see good reefer volumes coming out. Dry van capacity is tightening though, like in the Pacific Northwest. So I think some of those carriers that normally haul dry freight with reefers are taking advantage of some of those good lanes. So again, I think it'll be very localized in terms of the tightness in capacity in the next week to 10 days.
Yeah. All right. We got a ton of questions coming in, and I apologize for being impolite. I was trying to look at my phone. I still can't see LinkedIn comments whenever we're broadcasting, so I'm going to try to hammer that out over the next week. But our wonderful marketing team was able to plot them in the chat for us.
Yeah, it's a good question for you. Gary Bates asks, how do you address the oversaturation of brokers? Should they pivot to buying trucks in order to secure the declining volume?
First of all, it's good to see a question from Gary. We haven't heard from him for a while. I would say no. I don't know that if you're a broker, your business model is designed. So there's like standalone brokers, and then there's almost all large fleets nowadays have non-asset wings, right? So brokerage wings to their asset operations. I would say if you have that sort of optionality, now's a good time to kind of lean harder into your contract-based asset fleet for sure. but I talk to a lot of brokers every single week. We have data from 99 of the top 100 brokers, and then another 10,000 after that. We're not seeing these precipitous declines in volumes, right? Is it slower than last year? Yeah, but does 70 miles an hour feel slow when you're used to going to 100 miles an hour? I think that's kind of what you got to ask yourself. I think where they're losing in volume, they're making up for it in margin expansion, because brokers, we have the hard data that shows they were more successful than any other point in modern history on securing contract volume. So that contract volume that they secured at a market high is now being moved under current market spot market conditions. Are shippers starting to rebid all that freight, or have they already? Yes. So that's what you're bringing the contract market down, and that's what's starting things to levelize. We're starting to see a lot of signs of market bottoming that's very consistent with our forecast that we've been talking about on this program for the better part of 6 months, that sort of has things flipping back positive in Q1 or very early Q2 of next year. Do you agree with that, Dean?
I do. Yep. Another question. Scott Miller asks, what are our capacity expectations for Thanksgiving and Christmas? I think I'll have a crack at this one. I think there's plenty of trucks in the market nationally. That's evidenced by the fact that reefer rates are dropping as opposed to going up when what they typically do between now and Thanksgiving. Plenty of trucks in the market, in the spot market in particular. I think that's reflective of the number of new carriers that have entered the market who have been predominantly playing in the spot market. That's going to be, I think, the story this year that's going to provide a lot more capacity and keep rates sort of flat, I think.
Yeah, it's good to see Scott again, too. I know, we haven't heard from him in the questions for a while. But yeah, I think that's right. I mean, this is always a time when truckers justifiably take time off to spend with their families. Right. So it's going to get tighter. The question just becomes, to Dean's point, what's the watermark that you're working off of? Last year, when they took off, if they took off, they were competing against an incredibly tight market. So that's what sort of blew things up from a pricing perspective. Yep. If it's softer this year, the big contract fleets certainly are not going to go out of service. They might reduce number of drivers on the road, but they're still going to be there. So you still have that backstop of fundamental capacity, if you will. Probably a good point to reiterate, a lot of the stuff that Dean and I talk about, probably 99% of the stuff we talk about, we're talking about like the margins. Not like don't think about this in terms of like the financial margins, but like what's happening on the margins, like the incremental units of capacity and the incremental units of demand. Like, is the last load out of Chicago going to get covered, and at what price? Is the last truck in Memphis going to get a high-paying load, or going to take a low-paying load just to get out of there? So a lot of what you're seeing, it's the same with stock prices. It's the same with any sort of high-volume, highly liquid market. You're talking about what's happening at the margins. You're not talking about sort of the norm, if that makes sense.
And it gets really difficult in the next week for dispatchers and operations folks as they try and shorten the radius of operation for their trucks to get drivers home. So you see a natural tightening of capacity, even on the contract side, as they try and keep drivers closer to home so that their home time can be guaranteed at Thanksgiving. So there is a slight impact in capacity there, but I think we've still got a lot of trucks in the market.
Exactly.
Stephen Linton asks, do you think contract rates and spot rates will draw closer together soon? He's a little surprised by the gap that continues to exist. That's a good question.
I mean, I think we're seeing the spot market move faster than ever, and the contract market is moving faster than ever, but it's still not going to catch up, right? You can't. I think a lot of people forget, and I think Stephen knows this as well as anyone, being a shipper. There's a whole process, right? You put the deal out to bid. Even if you're lucky and get through it in a couple of quick rounds and you mostly award it to incumbents, you still have to load it up into your TMS system, the new rates, and that's after you got all the papers signed. And if it's mostly incumbents, there's not a lot of red lines, but if you have some new carriers entering the mix, I'm sure there's some redlining that happens between the two legal teams. And then you get the rates in, and then they start to, show up in the rate data. We are seeing contract replacement rates continue to come in lower. So that tells us there's still quite a bit of momentum to contract rates coming down. As spot rates bottom in the first quarter, I mean, they're probably near bottom right now. I mean, they haven't. We've been talking about the margins. We've been talking about not nickels and dimes. We've been talking about pennies here or there, kind of moving around. I think you'll start to see contract rates towards the end of that quarter into the next start to kind of follow and glide up. So yeah, I think we might have as many as 2 to 3 more months of that gap persisting. Do you disagree with that, Dean?
No, I agree, and that leads into Matt Clark's excellent question. with truck posts increasing, do you see a pending exit of these excess carriers and timing? It's a tough question, Matt. It's actually a really good one. Carriers are coming off some record quarters on the large carrier side. We can look at some of the earnings calls. Owner-operators had a lot of runway this year based on some of the profits they generated in the last 18 months. At some point, that runway, you get towards the end of it. But I think my answer would be, Matt, that I think the carriers that are still in the industry now, after 6 months of record high, maybe longer record high diesel prices and spot rates declining, if carriers are still in the market now, I think they will make it. If you're getting a decent amount of the fuel surcharge in terms of fuel recovery, if you can, as you build it into your all-in rate, carriers are still doing okay, even with high diesel costs and operating costs. So I don't see the doom and gloom, but I think I'd be naive in thinking that the first quarter of next year is not going to be very, very tough for a lot of carriers. Focus has to be on cost control, slowing down, being very selective about lanes and deadhead miles, things like that. So, Matt, I don't really know the timing, but next quarter is going to be very telling, the first quarter in particular.
Yeah. KJ has a question. So CH Robinson just laid off 1,200 employees. In your opinion, will the potential company layoffs heavily affect the market, or is it too soon to tell? I would tell you that number has been sort of ninja revised. I can just tell by reading that where you get your air quotes news. Again, I think the best place to source stuff is not former or current employees on Twitter. It's actual company press releases, because C.H. Robinson revised that number down into the 600, 650 territory. And you're seeing this, right, with Twitter. You're seeing this with Amazon. A lot of the tech companies are facing this crunch. I would tell you that the best analogy I have is that feeling on a roller coaster when you get you go over the hill, and you get that feeling in your stomach where you're like, your body hasn't caught up with where you're headed. In any market turn, that's where businesses get caught flat-footed, right? If you put yourself, I imagine most of the people listening to the show, if not all of you, are business people or business owners or kind of involved in the day-to-day operations of a business. There's lead times. You're planning ahead. You don't hire for the people you need today. You hire for the people you need next week, next month, next quarter. And the businesses that do hiring really, really well have a great forecast for the people that they're going to need coming up. Because if not, you're constantly lagging, right? You're always, and this is something we know all too well in the tech industry over the last 2.5 years, is we haven't been able to staff up to our needs. So we have to make really hard decisions about what work gets done. So really good businesses, brands, businesses with really good brands, really good cultures, and C.H. Robinson I would put into that category. Amazon, obviously, maybe not so much Meta, but whatever. They get out ahead of hiring, and when the market pivots, they get caught oversupplied with folks, and it's a real shame, right? Because what I just talked about is the hard dollars and cents of it, but there's a human component. There's 650 people that are now going to be unemployed heading into the holidays, and that's a terrible thing. But I think that is just sort of a reaction to the market moving in a very acute way compared to businesses with move in a longer term planning cycle. Will it affect the market? I don't know. I have to imagine a lot of those folks and a lot of these positions are support, recruiting, right? The first people to go when the market turns, whether it's the tech market, whether it's the freight market, whether it's manufacturing, or recruiting and HR and onboarding and all that kind of stuff. So I think in C.H. Robinson's statement, there was a lot of folks in that area, as well as a lot of engineers and maybe some senior execs who are close to retirement. So I don't know that it'll affect necessarily the market as a whole, but I think it is indicative of where the market sort of is in its longer term cycle. Dean, does that jive with how you think about it?
Yeah, absolutely. We got time for one more question?
I think we have time for a couple more. I will add a couple things. I don't want to move off this point.
Okay.
DAT is hiring. So if you are impacted by these layoffs, not to be an opportunist here, but we are growing. We have something like 86 people to hire before the end of the year. I love hiring people from the freight industry, from the tech industry. So, check out our careers page. I posted on LinkedIn. You can go on my profile and see a direct link to our careers page. This is a great place to work. I could not tell you how excited I am every Monday to come in and get to do what I do. So check that out. And if you want to stay directly in industry, I would say this is indicative of a market condition. I've seen so many other brokerages and other industry companies posting that they have open positions. So go ahead and check that out. It's been cool to see all these makeshift job boards for industry folks that have popped up. Go check that out because the industry can still use tons of super talented people. Dean?
Jacob Flint asks, what's going to pay off more for dry vans, to work in the spot market or the contract market? I think the answer would be for a lot of carriers I know that are doing particularly well, doing a bit of both. Of course, carriers' contract rates will most likely include the fuel surcharge. So, but the spot market, I think, is there's a lot of opportunity in the spot market if you're pretty clever about where you run. So I don't know that it's sort of black and white, Jacob, as in it's either or. I think you could do really well in both markets if you've got good data and good insights into the market.
I mean, you're super fortunate if you have fungibility to go between both. Right. I mean, there's pretty much no market cycle where you're not going to be successful, right? If you have optionality between the two markets, you're certainly running contract right now. Probably sometime in the middle of next year, you're going to flip back to spot. I mean, keep an eye on this show, keep an eye on the DAT and other market signals, and you're set, right? I mean, now's certainly a time to be in contract. I will caution you, right, as we start to get towards that market bottom, pay very close attention to the contracts you're locking yourself into because you don't want to miss out on that upside that's going to happen. So it's great to have optionality, but it's also it means you have to be super vigilant of where we are in the market cycle.
Yep.
All right, Dean, plugs.
All right. Again, as always, on Sales Chatter tomorrow with Dan Deegan, 9 a.m. Eastern. I'll also be speaking here at the Women in Trucking Conference doing the closing keynote tomorrow. Swing by DAT's booth if you're here in Dallas. Don't forget to check out our new DAT One app. It's an all-encompassing app that takes 15 different trucking apps and wraps them all together. You can download that today. Lee Klasko from Bloomberg Intelligence is on the latest edition of Freightvine. It's a great conversation about the state of the industry. Lee's going to be on our show on the Tuesday after Thanksgiving. And remember, you can also find this week's market update at dat.com/market update or on our new IQ dashboard at iq.dat.com. And with that, it's back to Ken to wrap up the show.
I think Dean did a great job wrapping things up. We will see you one more time before Turkey Day. We'll be here next Tuesday at 10 a.m. Eastern. Lots of really great content, a lot of really great kind of informational things that our marketing team and Dean have put together. So I highly recommend checking that out. It's like your last real chance to get prepped before that final sprint to the end of the year. So I would use this time wisely. I know I always used to when I was in the industry. We want to thank you for joining us, and we hope we can see you next week and have a safe rest of your week. And for most folks around the country, try to stay warm. We'll talk to you later. Bye.
Okay. Bye, everyone.